Oil just fell 11% in a single week. That is not a dip, that is a crash, and most financial headlines are treating it like a gift: cheaper gas, lower inflation, markets cheering. But there is a completely different way to read this number. And once you see it, the celebration starts to feel a little premature. Brent crude fell to around $92 a barrel this week. The trigger was news of a potential U.S. Iran deal. Reports suggested the Strait of Hormuz could reopen. Oil traders sold immediately. And on the surface, that makes sense. Less supply disruption means lower prices. Lower prices mean cheaper fuel for families. Cheaper fuel means inflation pressure eases. The Fed gets breathing room. Rate cuts become possible again. Stocks rally. Everyone wins. That is the clean version of the story. Here is the messier version. The deal is not confirmed. Iranian leadership remains publicly pessimistic about the terms. Regional skirmishes have not stopped. The Strait of Hormuz is still closed. So oil fell 11% on a deal that may not actually happen. That tells you something important about where markets are emotionally right now. Investors are so desperate for good news that they are pricing in outcomes before they exist. That pattern has a track record, and it is not always a comfortable one. Now here is where things get genuinely interesting. Sudden double-digit oil price drops have appeared before, and they do not always signal relief. Sometimes they signal something far more complicated. In late 2014, oil collapsed more than 50% over several months. The headlines celebrated cheap gas prices, but what followed was a wave of energy sector layoffs. High-yield credit markets cracked. Emerging market currencies got destroyed. The regions most dependent on oil revenue went into recession. The cheap gas at the pump came with a real economic cost that took years to fully appear. In 2020, oil briefly went negative. That was an extreme case. But the pattern held. A sudden violent move in oil prices does not just reflect supply and demand. It reflects fear. It reflects forced repositioning. It reflects markets trying to process uncertainty at speed. And right now, all three of those things are present. Hold that thought for a moment, because there is a second layer to this story that almost every market recap this week completely missed. BlackRock's Investment Institute confirmed this week that Brent crude is actually the best performing asset of 2026 year to date. Read that again. The best performing asset of the year just fell 11% in a single week. That is not normal price behavior. That is a violent reversal in one of the world's most important economic benchmarks. When the best performing asset on the planet drops double digits in 5 trading days, something has shifted. And the question every investor should be asking is whether this is a new trend or a temporary overreaction to unconfirmed diplomatic news. The answer shapes everything from your energy stock exposure to your inflation expectations to your view on interest rates. If you are finding this useful, consider subscribing for more practical financial insights. Let's talk about what this actually means for different types of investors. If you hold broad index funds, you already have energy exposure. Energy companies make up a portion of the S&P 500. A sustained oil price decline would pressure those earnings. That matters especially if AI-driven tech stocks, which have carried the rally, start to slow down. The market needs sectors taking turns leading. Energy was quietly doing that job this year. If crude stays depressed, one of those leadership pillars weakens. If you hold specific energy stocks, the calculus is more direct. Lower oil prices compress margins for producers. Pipeline and midstream companies tend to be more insulated, but exploration and production companies feel price drops immediately. Now here is what this means for inflation and your household. Lower oil prices do help at the pump. Fuel costs feed directly into grocery prices, shipping costs, and utility bills. Grocery prices rose 0.7% in April alone, according to recent Bureau of Labor Statistics data. A sustained drop in energy costs could slow that pressure. But here's the critical distinction. Relief at the pump only materializes if oil prices stay low. If this 11% drop reverses when the Iran deal collapses or stalls, and Iran's public statement suggests that remains possible, energy prices snap back fast. And the families who already stretched their budgets expecting relief get hit twice. First by the original high prices, then by the whipsaw back up. That asymmetry is the real risk for everyday households right now, and it is the risk almost no headline this week mentioned. Now let's look at what you can actually do with this information. First, resist the temptation to make major moves on unconfirmed news. A diplomatic deal that has not been signed is not a fact. It is a rumor that markets chose to act on. Your portfolio decisions should not be built on rumors. Second, If you have been meaning to review your energy sector exposure, this week created a natural moment to do that. Not to panic sell, not to dramatically shift allocations, but to understand what percentage of your portfolio moves when oil moves. That awareness is free and incredibly valuable. Third, keep watching the labor data coming this week. The May jobs report and April job openings numbers will tell us whether the broader economy is absorbing these energy shocks. If hiring stays strong, the oil story stays contained. If labor data weakens alongside energy prices, the recessionary read becomes harder to dismiss. Fourth, for anyone holding bonds or cash equivalents, falling oil supports the case that inflation could ease faster than markets currently expect. That matters for interest rate direction, and interest rate direction matters for everything from mortgage payments to savings account yields to the value of long-duration assets. One number in one commodity market touches more of your financial life than most people ever track. That is the actual lesson from this week. Oil is not just energy, it is a real-time signal about global economic confidence. When it falls this fast on uncertain news, the market is telling you it wants the good outcome badly enough to price it in before it arrives. Sometimes that optimism is rewarded. Sometimes it creates the next risk. The market is moving fast right now. The people tracking these signals will be better positioned for whatever comes next.